Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. Today, we have a special episode for our listeners. In May 2026, Trepp hosted our Trepp Connect in New York City conference, bringing together leaders from across commercial real estate, structured finance, banking, and lending to discuss the trends shaping today's market. As part of our conference, Trepp CEO Annemarie DiCola sat down with Scott Rechler, Chairman and CEO of RXR, for a keynote conversation on what he calls the age of disruption, a period defined by rapid technological change, evolving workplace trends, shifting capital markets, and new opportunities emerging across commercial real estate. Their discussion covered everything from higher for longer interest rates and the future of office, to public-private partnerships, housing development, AI, data centers, and the investment themes that Scott believes will shape the next decade. And today, we are excited to share that conversation with our podcast audience. So we hope you enjoyed this special edition of the TreppWire Podcast that was recorded live. Let's get started.
Thank you very much. And everybody, we are really privileged today to have Scott Rechler join us. And I thank you so much for your valuable time. This gentleman needs absolutely no introduction, but he certainly deserves an introduction. So if you give me a moment, Scott.
Thank you.
Scott has built one of the most active investment and development platforms in the United States. RXR is a fully integrated real estate platform overseeing more than 30 million square feet and over $21 billion in assets. He has operated at the intersection of real estate, capital, and policy, from helping to guide major infrastructure transformations in New York to being the master developer of a revitalization project in New Rochelle, New York, my hometown, and I'm a big fan, to serving on the board of the Federal Reserve Bank of New York. He's going to share his wonderful ethos for RXR, many maxims, many guidelines and principles that guide this phenomenal body of work. And we thank you for being with us here today and this wonderful conversation about the industry. We have a group of people from across the entire commercial real estate spectrum. We're looking forward to this conversation very much.
Thanks, Annemarie, and I'm thrilled to be here. And obviously, Trepp has been a big part of RXR for a lot of years, so thank you for your insights and your intelligence.
Well, and thank you. Thank you for that. What we thought we'd do is start by asking you how you frame this market environment. There's been a lot of discussion yesterday and this morning about what people are seeing. You're also known as somebody who often reframes things. So how do you view this market environment?
It's an interesting time, right? And the way I would maybe just take a step back, I would say, we lived after COVID, what I called sort of crossing the chasm. And that was first having to sort of redefine how people live, work, operate, play, and how that impacts real estate. And then that being followed by the surge in inflation and then the historic rise in interest rates, right? So that was that crossing the chasm period that was, for our industry, a very complex, challenging period of time. Right. I would say as we entered 26, I would say we have finally sort of crossed that chasm, but on the other side, we found the age of disruption, right? We've come to a place that's very different than it was before. And it's really characterized by a pace of change that none of us have ever experienced and lived through and had to guide our business through before. A place where, there's new ideas, new innovations that are translated to new products, new preferences, new policies faster than anything we've ever done, right? So how do you adapt to that? How do you think about how that impacts our business? And we're a business, right, that generally has to think longer term. We make investment decisions on our side where, they're 5, 10, 15-year time frames to do this. So it is a more challenging, but in that challenges creates opportunity. And I think the biggest thing for our company and our ethos is the concept of getting comfortable in the uncomfortable, of recognizing that one of your advantages is evaluating what that landscape is, what's changing, where there are demand drivers that are going to be created from it, where there's headwinds around it, have conviction around that, and be agile and have a sense of humility that, the playbooks of the past and how we did things in the past may not work in the future. So what will work in the future, and just keep moving towards those changes.
Are there particular constraints that you see today, or do you not think in terms of constraint?
I mean, there's clearly constraints. I would say, I mean, and obviously I'm sure you've had a lot of these conversations about the more immediate current environment. And one of our themes, every year we write a white paper, which I'll talk a little bit more about. But one of the themes was we called it Trump tailwinds and Trump turbulence. The tailwinds was the view of going into 2026 that there was going to be a economy that was going to be running hot off of the fiscal side,
Right.
The capital being invested in the digital environment, the desire for the president and the midterms to really try to move things forward. And then there was the turbulent side, which is what could happen. So obviously we didn't predict that we were going to have the conflict in the Middle East,
Right.
but that happened quickly and created a lot of turbulence. Just like last year, we had the situation with the tariffs, right? That was something. So when that happens, you have to take a step back and say, okay, what are the implications? And how does that, in the short term and intermediate term and longer term, potentially impact some of our strategies and business plans? And how do we need to adjust for that? So in this case, obviously, there's more inflationary pressure. We have a house view for a while now that rates are going to be higher for longer. So we've been investing with a view, particularly on the 5-year and up on the curve, that's not coming down. I personally have a view that this target for this 2% natural rate that the Fed seeks is really a 3% natural rate in this current transition that we're going through right now. Higher for longer is going to be an element here. And then the question on how long the conflict lasts. And while the U.S. economy has proven to be extraordinarily resilient, and I think more than most of us anticipated, the longer it lasts, the harder it's going to be able to maintain that level of resilience. So there's constraints that come from the geopolitical uncertainty, I think, is a big element of it. The policy uncertainty that's out there today that I think is out there. And I think that, one of the biggest things that concerns me as we enter this age of disruption is really whether our policymakers and government entities have the capability to adjust as quickly as they're going to need to adjust as the world adjusts, right? I mean, I was vice chairman of the Port Authority. I'm on the Federal Reserve Board. He said, I've watched these big bureaucracies. I've watched these institutions, and it's very difficult for them to adapt quickly. And so if they don't adapt quickly, we could have a situation where we need policies that aren't in place, or we have old policies that are constraining or harmful in that mix as well.
So into that environment, which you described so well, how does somebody make investment decisions? Real estate is always a complex market for various reasons at various times. But are there particular drivers? Do you boil it down to certain factors and things that in the middle of all of that, you say, okay, I'm going to look at these 3 factors or these 10 factors. How do you invest into this right now?
Yeah, so I mentioned this white paper, and it's foundationally it starts with that for us, and it's a forcing mechanism that we do every year where we write a paper. It started where we never shared it with any of our investors because we wanted to make sure we'd be intellectually honest with ourselves and not potentially think we would write something that someone would read and then would have a different element to it. Now we sort of do a couple of versions of it, but for 20 years we take a step back. We try to drown out all of the market noise. So we try to drown out all of the things that everyone else is saying and have conversations with our customers, with the people in public policy, with our team members, do our own level of research, and then say, okay, here's where we think the world is from a macro standpoint. And how does that then trickle down to the markets in which we do business, to the communities in which we do business, to our clients and our customers that we do business with. And from that, then there's still a sense of, okay, if this is what we think is happening in the world, what strategies that we have today should we lean into? What strategies should we pull away from? What new strategies might be available that come from that, right? Are all tied to real estate. Where are there gaps? Where is there demand drivers and tailwinds that we think are either there or will be coming that we want to make sure that we invest into that space, particularly if there's dislocation and others aren't investing in that space. And where can there be potential where there's over the supply, both either a capital supply or a supply of product that we don't want to invest in. And then so we come out of that with a real sense of conviction as to what we want to do And sometimes it takes us 2 or 3 years to actually have the conviction and vision that we had come to a point where it actually connects where the opportunity comes through. But we're clear that's our box. And we communicate that with our investors and other stakeholders and throughout the company, so everyone knows that's what we're aiming for. And then the second thing it does for us is it gives us a discipline, right? That we have an ability to look back, and when opportunities come in, and you all see it because our business is exciting, and probably our worst decisions were the ones that weren't consistent with the strategy, where we spent a lot of time and decided not to do something. So it enables us to vet quickly through what we should be doing and shouldn't be doing. And then it gives us a baseline to say, this is what we thought was going to happen. We've actually written this down. It's not happening. So now what, right? If it's not happening, how do we recalibrate from that? And so that strategic framework has really driven us into our investment themes, right? It gave us the ability, and when we sold our company in January of 2007, our predecessor company, a company called Rechler, it was a very hot market. The rents, the prices were going up. It was on top of the office market. And it was because I think we spent the time going through that strategy that we had the ability to see through it and sell, even though our investors never would say, why were you selling at that time?
That was January of 2007.
Right.
Very prescient. Very
Right.
prescient. Yes, excellent.
And that's a theme that we try to do. And then we did this in this cycle. We started investing in office again in 2022 in Manhattan. Bought over 7.5 million square feet of Class A office space from institutions that didn't want it because it was something there. And my view is, when something's uninvestable by institutions, it's a good time to invest, right? So that's where we try to find.
Right. That makes it more interesting for you.
Dislocation.
Right. No, fascinating. Given that philosophy, that approach, that discipline, could you take the group through a couple of the projects that you've done? I mentioned one in New Rochelle, New York, my hometown, and I'm a big fan. And whether you want to talk more about that one or the JFK terminal that you did, the infrastructure projects you've done, just as examples of how you've applied that investment philosophy to extraordinary projects that RXR has done.
Yeah, no, sure. So one of the things that we pride ourselves on is public-private partnerships. And myself and a lot of our team members have actually done public service, worked in government. And so we have a good understanding of when you sit down with a counterparty in government, how do you design partnerships that are win-win-win? Win for us, win for the government, and win for the community at large. And so because of that, we've been active in the fronts like New Rochelle as an example, where we had a thesis in one of our white papers that there was such a shortage of housing in New York, and you saw how the boroughs were getting stronger and stronger. Well, if you could take that one ring further and look at transit-oriented development, that we're only 30 minutes by rail from New York into these suburbs, that were these suburban downtowns that were in their heyday, were doing well, and then they got tired, and they had, as I would say, they had more parking lots than tax revenue, right? And so our concept was, how can we turn those parking lots into tax revenue and economic development? And so we began around the area here. New Rochelle was one example, but we did it in Glen Cove, we did it in Yonkers, we did it in White Plains, where we would go and make a deal with the municipality that we would build on their municipal land, put a master zoning overlay, and really take an economic development approach to it. So it wasn't just building the buildings, but using the buildings to be a spark to the broader economy. Hire locally, train people, work with the local schools, work with the local non-for-profits, work with the small businesses so that they didn't get gentrified out, but that they prepared themselves for what was going to happen. And also not limited to RXR, build the plan that you could get a critical mass, right? So in New Rochelle, it was open for everyone that you had this zoning overlay, that you knew that if you went to that site, you could actually build X number of units of housing or whatever the amount was. And if you did a little bit more of affordable or a little bit more of public improvements, then you get more. And so 6,000 units have been built in New Rochelle and has really sparked a revitalization of that downtown that didn't exist. And I give a lot of credit, obviously, to the municipality, the mayor, the people in the city council for being willing to take that leap, because it's not an easy thing to do in areas like New York, which is not a very, pro-development type place.
No, it's fascinating because we've had construction cranes in the city now for a few years, and we love it. because the residential dwellers that are coming in need coffee shops and restaurants and other retail, and they have pets and strollers and all those great things that make for a bustling neighborhood and really, really aid the economy. And so you mentioned other cities within Westchester that you've also done this. Are there other New Rochelles around the country that you're looking at?
Yeah, no, I mean, so we're working on interestingly to your point on this, for a long time, we didn't know if this skill set was portable to other geographies. Because we did this in New York, we understand New York, and so we avoided trying to take a risk of going to other geographies. And a few years ago, we decided, we came across an opportunity in Raleigh-Durham in the Research Triangle, where there was an 1,100-acre piece of debt that was foreclosed on, that it was zoned, but didn't have sewer available to it. And if you looked around it, there was tremendous growth around it, but because they couldn't build on this land, it wasn't there. So we actually decided to go and we bought the land and went down to this place called Apex, which is the town there. And we actually, I'll tell a quick story. We have the guy who runs our master development guy. You would think of him sort of, he was in the karting business, right? So think of a real New Yorker, right? We were like my cousin Vinny going to this place. And we meet with the mayor, and the mayor is a very, well-dressed Southern gentleman. And we sit down and we tell him about our philosophy and how we do good and do well and how everyone's going to do better and how we work with the community, and went through a whole pitch about our vision for this site. And he says, listen, Mr. Rechler, I think you have a great company. You have a great vision. I appreciate your willingness, but before I can move forward, I really need to ask Joe, Mr. Graziosi, to do me one favor. And Joe says, Mr. Mayor, whatever you want, I'll do anything. And he says, can you say, forget about it? And he goes, forget about it, Mr. Mayor, forget about it. And then they became best friends, right? And so everyone loves a good New Yorker. And it's become a great public-private partnership. We partnered with the state of North Carolina. We just sold 200 acres and worked to build the second largest children's hospital in the country on the site. We sold a piece to Wake Tech for a university on the site. We're building an elementary school on the site. We're building 4,000 units of homes, multifamily, retail, logistics, right? So you're building a whole city.
You are.
And that's part of what in our business is rewarding, is you're changing the communities in which you do business. You're changing the landscape, right? And so it's not just a financial reward, it's a social reward, which is why I said our corporate values is doing good and doing well means doing better. We want to leave the communities in which we do business in better when we're done. And even here in Manhattan, where we're going to tear down the Hyatt Hotel and build the largest commercial building in the Western Hemisphere, this has been and something we started in 2019 to build an office building and carried through with our partners, invested $300 million so far, and now we're finally getting ready to break ground. But you don't realize, you have to persevere through that uncertainty. If COVID hit and we just said it's not going to happen and we're going to stop, then we would just basically never be able to do it. We had to get all the plans, all the approvals, and get ready to go. And now the markets are ready.
So I want to get back to the topic of office, but first, on the public-private partnerships that you mentioned and the projects you've mentioned in New York and North Carolina, how do those actually begin? Like, what's the spark that starts it? Because that is a multiplicity of agencies, governmental officials, other talents and discipline. Those projects are great because there's a place for virtually every discipline in those projects, right? But how does something like that begin? These are multi-year, multifaceted projects. And how does your vision remain intact through the years that takes and the various interests that are involved?
Everything I think begins in a different way, right? So at JFK, we're building a Terminal 6, which is right by JetBlue. And in that instance, JetBlue had a piece of land and they wanted to expand their business to international. And so that people could fly into this terminal, more of a boutique terminal, 11 gates with, their own TSA, and then go to JetBlue and go from there. So they ran an RFP to be able to find a development partner that would build it and own it with them for the concession of going through this. And when I was at the Port Authority, I led the public-private partnership at LaGuardia Airport and helped the master development plan for JFK. So we decided to bid on it with a partner that manages airports, Vantage out of Vancouver. And we bid, and it was interesting. We bid against all the traditional infrastructure investors, Carlyle, Blackstone, Goldman Sachs. They chose us. And when the CEO of JetBlue told me that he chose us, he said, I chose you because people think of infrastructure as a financial instrument, a game. But the reality is it's a development. Someone's got to ultimately design it. They got to go through the regulatory process. they got to get community support, and then they got to build it on time and on a budget. And the skill set of RXR is much more in tune with that than a financial allocator in that mix. And it was a smart decision on their part because, again, we got awarded this project in 2017 and then ended up negotiating with the Port Authority and then having to live through COVID, right? So, and then having to redesign. And then, by the way, JetBlue, which was going to take the majority of that terminal, pulled back and needed one gate, not 11, right? And so we had to now go redesign for all of that. We had to go it was on the I don't know if everyone knows this, but JFK's on a ground lease that's owned by New York City. There was only 30 years left on the ground lease. So in our bid, we had to negotiate an amortization of that over 30 years because you give it up at the end of 30 years. So when COVID hit, it became uneconomical. So we had to go to the city and the Port Authority and the state and negotiate a 10-year extension to make it a 40-year ground lease, right? Which is something no one thought was viable, but the moment of time. And there's two things I would say that, and I was actually at the mayor's office yesterday meeting with them about public-private partnerships that are critical. One, you need to approach it with you have what I call an air game and a ground game, right? The air game is you need the leadership, the stakeholders from the top to be bought in and trust you. At the same time, you need a ground game that you're working with the local community stakeholders, whoever they are, that they're part of the process and they have a voice and they trust you. If you do one of them right and not the other, you're not going to be successful, right? So that's the first thing. The second thing is, and this is, I think, a flaw of a lot of developers who approach this, is that it needs to be a win-win. I've gotten involved in some of these before where a very smart developer negotiated a great deal with a municipality because they out-negotiated the municipality and they're so happy they have this, great financial deal. The outcome is it never gets built. Sure. And vice versa. If the public takes more, then it never gets built, right? So if you had to force it to find what's balanced to be able to make it a win-win for both sides.
Fascinating. You mentioned office. You mentioned the office building that's getting built now. Obviously, office has been a big topic of conversation over the last few years. With office, and we see office buildings that are seeing great successes, and we see others that are languishing. Do you think this is a cyclical shift in office, a structural shift in office? What are your thoughts on that asset class?
No, I think it's definitely a structural shift on office. And again, going back to sort of our white paper during COVID, we spent a lot of time trying to study what's the future of office. And, and you think about our business at the time of COVID, we were still just New York based as a firm. So, and, New Rochelle was the first hit. If you remember, we had they ended up sending the Army basically closed off New Rochelle. I remember calling the mayor the first day, what could we do? Right?
Because of an outbreak of COVID with New Rochelle residents, and they had to quarantine a good part of the
and we were one of the largest owners of office space. So clearly we took a direct hit in COVID that we had to take a step back and say, what are we going to do? And what's going to be the other side of this? And I think when we got past the fact that people were going to be paying rents and people were coming back to the workplace at some point in the vaccine, then what was the future of office? And in 2022, we did a internal study that we called Project Kodak. And we said, just like film, and there's going to be a point where some buildings are going to be digital and they're going to have a future. And some are going to be film and are not going to have a future. And we can't be like Kodak and ignore the fact that it's not going to have a future.
Right.
We got to focus on which are the attributes that would make a building digital. And those are the ones we should be investing the capital in. And the ones that are going to be film that aren't going to be coming back, we should acknowledge that and either determine a repurposing of it or repricing of it or resetting a basis of it. We weren't going to put good money after bad because we did view this as a structural outcome and also a cyclical outcome in the sense that the values that existed pre-COVID we're going to need to come down, right? So that this is not going to be something that even if it was digital, that we didn't want to live through this period and not reset the basis for what the future was versus where it was. When you think about what that is, what is digital is, it's almost like, you think about the mall space when people would use e-commerce, they stopped going to malls. Everyone said they'd not go to any malls. They wouldn't go to malls just to shop, but they would go there for an experience. And it's the same thing with office buildings. You're not going to go to an office building to sit in a dark office building. You want to go to a place that brings energy, collaboration, that's got a sense of hospitality, experience, easy to get to. And so we went through and defined that, and that's how we've been investing in our own portfolio and in our acquisition strategy.
And you've also entered the office to apartment conversion space. Can you talk a bit about what makes you make that decision that it's evidently film because it's not going to be a thriving office building? How do you decide, besides floor plate, what else makes it a great apartment conversion opportunity for you?
Yeah. No, well, first, I want to give a shout out because before I said one of my biggest concerns is from a policy standpoint that government won't be able to react quickly enough to a changing environment, and this is one of those exceptions. And we were advocating as amongst other people in the industry, where I would sit down with the government and say this could be a 20-year problem of having to deal with obsolete office buildings that were once an asset to our community are now a liability, sitting vacant, vagrants, retail not being supported, or it could be a new opportunity to reimagine our communities to convert these to residential, but it's not going to happen without economic incentives and policy changes.
Sure.
And they put in place this program called 467M, which defined which buildings would qualify and provided a 35-year tax abatement for 90% of the real estate taxes. And so what that did was it opened the aperture of what buildings could qualify and financially be viable for conversions. And so, where it used to be just lower Manhattan, you can now do them in Midtown. So we're doing 5 Times Square as an example in that mix. And so what do we look at, right? First, the biggest thing for us is structurally, can the building naturally convert to residential? What's that floor plate look like? How, when you convert it from office to residential, how efficient is it to be able to have how many apartments per floor that pay rent? A lot of buildings aren't efficient in that regard with being able to have the windows and the depth of the floors,
right?
So that's the one. The second thing is, can you get the tenants out, the office tenants that are in the building? You got to get it vacated. The third thing is, what's your basis, right? Because at the end of the day, you need to have a basis. If it's lower Manhattan's got to be $200 to $250 a foot. In Midtown, maybe it's, $400 a foot, somewhere in that range, that it makes economic sense to go through it, even with the tax abatement. So we're doing right now 4,000 units in Manhattan. And it's an extraordinary situation because you're removing these office buildings and you're replacing them with residential, and you're creating these 15-minute walkable submarkets in Manhattan where people can, live and work 7 days a week, and the restaurants and everyone does better, and the energy of it's better because of it.
Absolutely. Now, for people who look at office buildings that are film, not digital, and that aren't able to be converted to apartments and are having trouble, they're stressed out, what do they do? What are some of the options?
Yeah, listen, it's a tough situation, right? I mean, I think we've had situations where we've been able to get things rezoned and repurposed. I mean, you mentioned the White Plains project we just did and that we've refinanced. There's a good example of that. Was a mall. There was a downtown White Plains mall. Right.
Yeah.
It was from 1970s, and it became, right across from the Ritz-Carlton, right down the road from the train station.
Great location.
Right.
Great
but it sat vacant for 10 years other than a DMV office, right? So,
terrible.
And it took a long time.
Right.
But ultimately, we went to the city and said, listen, we can convert this into something that will bring energy to downtown and be a benefit to downtown. But we need help, right? We need some tax incentives. We need more density. And they, did that. And so I think you got to be creative of what the alternative uses are that make sense. But it's not a quick process, right? There's no silver bullet answer to solve some of those situations.
Absolutely not. When I think about all you've done in New York, and you've mentioned North Carolina, are there other parts of New York that you see besides Manhattan, New York City, other parts of New York City besides Manhattan, like the Bronx perhaps? Another where I grew up. So you see, I want you to take care of every place
there we go.
or ever lived.
Should have told me, give me your roots, your history before I got here. I would have brought a map of buildings.
Are there other parts of New York that would also benefit, New York City, that would benefit from more of these public-private partnerships, revitalization areas, sections that could use a lift and maybe be converted from film to digital?
Well, I mean, you mentioned the Bronx, right? I mean, I think that's an area we're invested in the Bronx and Mott Haven. So there are what I'll call emerging submarkets, right? That's the terminology we use with either within New York City or outside of New York City, and frankly, when we invest around the country, which are submarkets that have character, that have transportation, but have not had the investment in it and to be able to be successful. The key is you got to get critical mass and you got to be patient, because even New Rochelle, it's not, you're not building into something that's mature. right? So it takes time not only to build, but you got to get the scale, the quality of life. The elements have to change, right? So you need to be the critical mass to get that, and so you have to be able to ride through a longer cycle than you otherwise would, right? And so, and we've seen it in New York, obviously in Brooklyn, we've seen it in Long Island City already. Bronx is behind in that mix right now.
Right. Okay. Well, looking forward to that someday. Other cities in the country that you mentioned that you've invested in?
Yeah, so when we decided to expand around the country, we said, what makes New York work? How do we think about what other parts around the country would have similarities? And one of the things that sparked us was when Amazon went out in 2018 with their HQ2 approach, right? And it made us think, okay, what's happening is our customers are realizing that the talent doesn't have to be concentrated in one city, but it could be dispersed in other parts around the country where the quality of life and affordability would make it compelling for that talent to want to be. And so we began to study other parts around the country, and the theme that we used was we called EDS, MEDS, and well-eds. So we said places that have good education systems and good healthcare systems tend to be a proxy for talent. And then leadership that's investing in infrastructure, quality of life, job training, affordability, so that would be sustainable. And went through and sort of screened the markets for that. And then we said, okay, now on a real estate lens, from a supply and demand standpoint, we'd want to invest in markets that were big enough that if there was excess supply, it could be absorbed, right? It wasn't something that was small and it could just take years to absorb that. And from a demand standpoint, we wanted diversity of drivers of demand. So not one industry, but multiple industries that were driving the demand of those markets. And so with that lens, we're in Phoenix, Arizona. We're obviously in North Carolina, both Charlotte as well as the Research Triangle. We're in Tampa. We're in Orlando. We're in Dallas, Denver, anywhere from Philadelphia up to New York. But we've skipped places like Austin, Nashville. We decided not to invest in. San Francisco, we decided not to invest in because of tech. So we've been very selective, particularly when we are investing in equity or equity-like investments. In our credit side or capital solutions side of our business, we'll be a little bit more flexible because we have more of a cushion to where that is.
Fascinating. Thank you. Let's switch to a topic now that we've talked about a lot here and we will further today. AI. How are you finding AI within the process of real estate? And what do you think of AI and its impact on the use of real estate?
So obviously a question we all think about a lot, like everyone. And I think there's a tactical side to this and a strategic side to this, right? The tactical side is implementation at RXR. And, I'm of the view that with AI, that it's riskier to move slow than move fast, right? It's almost counterintuitive, but it's riskier to move slow than move fast. Because if everything around you is moving 10 times the speed of you, then you're exposed either competitively or from a security standpoint, unless you can keep up with that. And so the theme at RXR is AI first, right? That's where an AI first organization with guardrails, obviously, to protect it and systems in place, but deep into it. I mean, even just last week or 2 weeks ago, right, Steve, I wrote a Jerry Maguire note to the team about we're going too slow, right? We got to go faster in adoption, and it's got to be all over our organization, and everyone's got to be an AI native within RXR if we're going to be competitive and understand things. And what's great to me is I view AI as an augmentation, not a displacement, right? I watch people augment their skills, their experience, their capabilities, their thinking, particularly, in the more challenging, soul-crushing tasks of number crunching and data this and that, where they now can actually, put into, the AI application and say, this is what I'm looking for, and someone else runs the models for it. It comes out. That used to take them 10 to 12 hours, and they can review it and say, something doesn't look right here, do it this way, which they never, in the past they may not have done, right? So it's forcing people to think and be more creative and understand what the data is telling you versus just being lost in the data. And so that's a big positive. The second thing is, processes, efficiencies. How can we, be more effective on that front? And then the third thing is, with every piece of our business, how do we implement it to do things we otherwise could never do, right? So a couple of examples, things that we're working on now, like on our credit business, we built an AI agent called RexAI. And you think about when you do your underwriting, you spend all this time understanding the market, the sub-market, what are the trends. But then when you're servicing the loan and you're following, it's impossible to spend as much time studying that. Well, Rex AI is trained to basically do that underwriting every day for every one of our loans. So it will look at, if we have a loan, where are there leading indicators that there may be challenges. So if there's crime rate adjustments, if there's new zoning being put in place for a data center that might increase electrical costs, weather patterns that might impact insurance, all these different concepts that our teams put together, that it reads all the newspapers, it looks at all the public filings, and then provides back a set of things to focus on.
So it's a daily updated reread of everything, that all the variables.
And if you don't get lost in the data, what are the highlights? Where are the changes? Where are the things that you want to be focused on? And again, it may not mean anything other than we should be aware of it and watch it more carefully.
Right.
But
right.
But it's something that would be an indicator that we otherwise would not know.
Fascinating.
Right? Another example of one that's really intriguing that we're just getting ready to roll out is we do a lot of construction financing. When you're monitoring construction loans around the country, how do you send someone out every day to see, or is it on time, is it on schedule? So in our venture fund, which we have 50 different investment in the different AI related companies, we have one company that has a drone that goes into like a little mailbox, and the drone will go out during the day and it will fly around the property. And then it uses AI to compare the status of the construction against what the schedule was, and it will provide us a report, or are we on time or not on time. And then it goes back in the box and charges itself up until next time you're ready for it.
Fantastic.
Right? So think about these things that are out there. So that's the tactical part. The strategic part is, I think this digital transformation in AI that we're going through right now is obviously great from a societal standpoint. But for someone who lived through the tech bubble, I see too many similarities as to where that is. And the amount of capital that is chasing AI and data center building today in particular, I think is a risk. And because what's happening, going back to my infrastructure days, people are valuing this like infrastructure, like it's done, and they're willing to take returns like that. There's a tremendous amount of execution risk to be able to do this. So I think the return thresholds that people are willing to accept are not appropriately priced for the risk that's associated with it. And then there's the overbuilding piece of this that no one, really knows where that's going to land. Mm-hmm. But if you look at history, it's going to land that there's too much capacity long term, right? And so if you look at the .com bubble, there were, out of all the companies, 90% failed. Now, in retrospect, the 10% that survived were transformative for us all and was great, and it was worth the investment. Right. But a lot of people lost a lot of money along the way. Society, we did well, but a lot of people lost a lot of money. The CEO of IBM sits on the Fed board with me, and he was using this analogy. He said in this cycle, he thinks 35% will survive. Right. And he thinks it's 2 to 3 years before we're going to know who's not wearing a bathing suit. But 35% is still 3 times better than 10%.
Right.
But my point is, you've got to be very careful as to where you're investing. So we don't invest in that space directly. We do things where, in the digital economy and the onshoring and the reindustrialization, logistics, and all these things that will benefit from it. I also am a big believer that office buildings in New York benefit from it, because when you think about AI, it's an application. The application needs to be fed to be able to generate revenue. And so I look at, like, in the AI era, data centers is where compute power happens, but in it's New York office buildings where people power happens. And people power is what creates the applications that ultimately create the value for AI.
Interesting. Very, very interesting. Longer term, if AI is reasonably successful, and maybe this 35% will succeed, 35% of the effort, 35% of the data centers and all of that. There's a lot of concern about jobs that may be lost, or even the thought that if it augments people, then maybe more people aren't needed to be hired in a company. Maybe you've got the right headcount for a long time. What's the long-term view of that for office occupancy, building occupancy, commercial real estate usage? Is that something on the horizon?
Listen, I think there's clearly going to be displacement of certain jobs. As I said, I am a believer. There's also going to be augmentation and new jobs created, right? So I'm a believer. Net will be better and as a society, right, when we get to the other side. It's the transition that is the issue, and it's that there's some subsets of the economy and some subsets of different industries that are going to be more impacted than others, right? And so that's the challenge, is that this could be a 5-year transition. At the end of 5 years, we may look back and say, wow, we didn't lose any jobs, except for the fact that during that 5 years, or certain families and certain people may have been hurt during that process. And so there's going to be some of that in the mix. The other thing I would say that's important here, and I think for all of you in this space, is what's happening right now is the AI and digital infrastructure build out is squeezing out so much of the rest and distorting so much of the rest of the U.S. economy and the real estate space. So if you think about the quantum of dollars that are being invested in these projects, that means there's less dollars going to build housing. That means there's less dollars to go office. When I go meet with our investors, it's there, and the head guy is real assets. Real assets includes infrastructure and real estate. Infrastructure includes data centers. I mean, think about it. When was there, a one project, $30 billion office building or mall done, right? But that's one data center, or $15 billion, one data center. So there's a capital squeezing out that's happening. And even you think about the treasury markets, we were talking about, where rates are going to be. One of the reasons I think they're higher for longer is that, the forecast now is there's going to be more corporate issuances than treasury issuances because of this digital infrastructure, right? So fighting for dollars means you got to pay a higher rate to be able to attract those dollars. And then I would say, just at a very basic thing impacting our business and a lot of our peers, is getting resources, equipment, labor in a world where people are paying with funny money and can pay a lot more than you can with a commercial project or a residential project. And so it's very difficult, and something that we're spending a lot of time trying to mitigate, getting the labor and the equipment. Like, for example, our 175 Park building, we're buying now turbines, generators, because we're not going to be able to get it if we wait to the end.
Interesting. Very interesting. So a bit of temperance about the AI boom and the data center boom related to it is probably in order. Right?
Again, I would just be cautious.
Yeah.
And I was at the Milken conference the other day, and in one of our sessions, I don't want to say who said it, but said that basically they're even now building spec data centers. Now, so they get the power, they get the location. That's new, right? I mean, we used to have, one of the big users was the tenant. And so now then it was, is one of the groups that was the co-locators that can then had the relationship with the tenants. Now they're just building it and assuming they're going to come.
Somebody will come.
Right. So these are signs that, you're getting at a point where it's frothy and dangerous.
Very, very interesting. I wanted to ask you, what advice do you have for two cohorts of people? There are people in the real estate industry today who are looking for new jobs. They could be junior to middle career level. And also, Steve Schwartz and I sit on the advisory board at NYU Stern for the Center for Commercial Real Estate Research. And there are students who are studying to be in this profession. What advice do you have for people looking for jobs, changing jobs right now? And what advice do you have for students coming into the real estate industry?
It's, and thank you for sitting on NYU Stern as an NYU board member. I appreciate it, but an alum. But my AI first comment would apply here also. This is like the advantage that particularly younger cohorts have, is they are more technologically native and ability to adopt and understand and utilize technology better, right? And so, if we're hiring and someone walks in and has capabilities on, using AI tools, that's going to be something that we're going to overweight over maybe them having some domain expertise that we can teach them, right? Because we can teach them the domain expertise we know, but you want people that will change that culture and move quickly. So I encourage everyone to think about how you can hone your AI skills for whatever, and make them relevant for whatever industry you want to get into to be successful. The second I'll just say is I started in the industry in 1989, right? And again, it was a very similar time where we just were coming through the RTC and the savings and loan crisis, right? And so, in moments like this, in which it may have been 4 of them in my career, they're inflection points, right? They're inflection points of where the way that the industry worked before isn't the way it's going to work again. So what that means is that young or ambitious people who are willing to not get stuck in the past and say, this is how we did it before, will be able to actually set the road to be the future leaders by playing with new playbooks. And so while it feels uncomfortable, it's actually a great opportunity to be able to, to grow your career at a time that there's this transition going.
Great advice. I think for a final question I wanted to ask you is, what are you optimistic about? There's a lot of optimism in much of what you've said, but when you look ahead the next few years, what makes you optimistic about this industry, the country, the economy?
First, I'm optimistic about our country, and I travel a lot around the world. I'm going to be in the Mideast again next week. When I talk to people and I watch where there's no place they'd rather invest or come to than the United States of America, and frankly, New York being the top place, right, in the mix here. But there's no place that is as innovative, as entrepreneurial, is agile. So I know we all like to complain, and it's like a lot of divisiveness politically, but the bottom line is the American dream and that ethos that we have and that this country creates is something no one else has in the world, right? So it's something that gives me a lot of confidence that we're going to work through all this. I also believe pendulums swing, right? And sometimes they swing too far one way, sometimes they swing too far the other, but eventually they find the center. And as a country, we've always found the center along the way. And then the last thing I'll just say is, I love all this change, right? I love what's happening with I don't complain about the data centers, but I love the disruption is opportunity, right? I'm most uncomfortable when everyone's making easy money, right? That's just too easy. Some things doesn't make sense to me there. I'm most comfortable when you got to work hard, you got to be operators, you got to focus on building your business. What's your competitive advantage? There's that moment in time, which is we're in right now, where it's a cycle. When you get on that train, it's a 10-year cycle. And we're on that, we're at that, we're at the train station today, getting on that train. And everyone who wants to participate, this is going to be at least a 10-year run of transformative times, challenging times. But on the other side, those who lean into it are going to come out a lot better than going into it.
Fantastic. That's great advice. Great advice. Great sentiment. I want to thank you so much for your generosity and for sharing all of that. I know it's been very valuable. Thank you so much.
Thank you so much.
Such a pleasure.
Thank you all. Thank you.
And with that, we'll close this special episode of the TreppWire Podcast. Thank you to Scott Rechler and the RXR team for joining us at Trepp Connect. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well. All right.